In this video, we'll explore 9 effective strategies to legally minimize your tax liability, helping you keep more of your hard-earned money. Let's dive in and unlock the doors to financial freedom by delving into these different strategies. Income tax allowance. 1. Your free pass. Everyone gets a personal allowance of £12,500. Think of it as your tax-free VIP ticket. 2. Beyond the 9 to 5. It's not just your job. Any income, like pensions or rental cash, plays in this tax-free zone. 3. Withdraw smartly. Got unused allowance? Time to check if your assets can shower you with tax-free income. 4. High earners alert. If you're in the £100,000 club, your VIP ticket shrinks. But fear not. Stash that bonus in your pension to keep the taxman at bay. 5. If your income exceeds £100,000, your personal allowance will be reduced. For every £2 you earn above £100,000, you will lose £1 of your personal allowance. Marriage tax allowance. If you're married or in a civil partnership, then these are for you. 1. Sharing is saving. If you're hitched or in a civil partnership, you've got a tax teamwork play. You can pass on 10% of your personal allowance to your spouse or partner, forming part of the fantastic 4 ways to trim your tax tab. 2. Couple criteria. To tag team this tax hack, the lower earner, probably you, should dance below the £12,500 personal allowance limbo bar. Simultaneously, your spouse, civil partner should keep their income tap dripping below the higher rate tax threshold, £50,000. 3. Cash in the savings. Sharing isn't just caring, it's cashing in. This tag team move can pocket you up to £250 in tax savings. 4. Pro tip for the win. Feeling like a financial superhero? Pro tip time. You can time travel your application up to 3 years in the past. Activate this DeLorean move, and you might pocket an additional £750 in tax savings. So there you have it. A tax-savvy tango for couples looking to waltz through the tax landscape. Next one is Personal Savings Allowance. Let us see how much you can save in this category. 1. Tax-free savings interest. Non- or basic rate taxpayers enjoy up to £1,000 per year tax-free on savings interest. Higher rate taxpayers have a £500 per year allowance. Additional rate taxpayers, unfortunately, get no allowance. 2. Interest realities. In today's low-interest environment, amassing £500 or £1,000 in interest requires substantial savings. For instance, with a 1.00% interest rate, you'd need £50,000 in savings to achieve £500 in interest. 3. Joint allowances. Each individual benefits from these allowances. If you and your partner hold joint savings, both can utilize their respective allowances. Extra benefit. Starting rate for savings. Let us see how you might qualify for the starting rate for savings. This sweet deal lets you pocket up to £5,000 per year in savings interest without a tax nibble. Eligibility check. To snag this bonus, ensure your income stays under the £17,500 per year mark. Every £1 of other income above your personal allowance, £12,570, reduces your starting rate for savings by £1. Example: you earn £16,000 of wages and get £200 interest on your savings. Your personal allowance is £12,570. The remaining of your wages reduces your starting rate for savings by £3,430. So now your remaining starting rate for savings is £1,570. This means you will not have to pay tax on your £200 savings interest. Let us look at one more well-known tax-saving way: ISA allowance. ISA perk. Everyone gets a £20,000 annual ticket to the ISA party. Think of an ISA like a nifty wrapper that can snugly hold assets, whether it's stacks of cash or exciting stocks and shares. Cash dilemma. Traditionally, many tossed cash into their ISAs, especially when savings interest was taxed. Smart move: stocks and shares. A savvy move is considering the stocks and shares route for your ISA allowance. This shields you from dividend tax and capital gains tax. We'll delve into those goodies shortly. ISA makeover. Already got a cash ISA? No worries. Give it a makeover by smoothly transferring it into a stocks and shares ISA, keeping the ISA allowance magic from bygone years. Now it's time to look into other tax-saving way, dividend allowance. Dividend delight. Here's a cool perk. You're entitled to a tax-free dividend feast of up to £2,000 per year. This especially comes in handy if you're the proud owner of shares, outside the ISA comfort zone, or sport the director's hat. Company hack. For the company maestros out there, here's a pro tip. Think about roping in your spouse as a director. Why? Well, it's a clever move to tap into their own £2,000 dividend allowance. Double the benefits. Another important tax-saving strategy is capital gains tax allowance. Let us dive into this now. Gains game. Let's talk gains and profits. Everyone gets a slice of the tax-free pie with a capital gains tax allowance of £12,000 per year. Sweet, right? Tag team taxing. Here's a neat trick. You can hand over your assets to your spouse or civil partner without a tax tussle. They can sell the gain, and if one of you dances to a higher tax tune, this move is particularly savvy. Sell and shuffle. Shake up your investments smartly. Sell those taxable investments, then play the reinvestment card wisely. For instance, flip the gains into a stocks and shares ISA. That not only taps into your capital gains tax allowance but also ensures future gains are tax-free. Win-win. Pensions are pretty darn amazing from a tax perspective. Let us roll the tax benefits as pension annual allowance pension powerhouse. So, up to the youthful age of 75, you can pump in up to 100% of your earnings or £40,000, whichever plays it cool. Tapered pension annual allowance might tap on the high earner's shoulders, though. Zero income? No problem. Even if you're living the no-income dream, £2,880 can still find its way into your pension fund every year. Sweet, right? Tax relief tango. Here's where it gets fancy. Funds sprinkled into your pension get a splash of pension tax relief. That's the good stuff. Tax-free growth and afterlife. Parking your funds in a pension. Smart move. They grow tax-free, dodging the income and capital gains tax duo. Even in the afterlife, they dodge the inheritance tax plot twist. Business buff, business owner. Your company can chip in for your pension, and guess what? It's a deductible business expense doing a tax tango against corporation tax. Tax savings won't stop here. Pension carry forward allowance in the form of time traveling allowance. Forget the usual, use it or lose it, drill. With pensions, you're the time lord. You can carry forward your pension allowance from the past 3 tax years. No losses here. Mega contribution magic. Drumroll, please. This means you could potentially sling in a whopping £160,000 into your pension. Breaking it down, £40,000 from the current year, plus £40,000 from each of the previous 3 tax years. That's the kind of math we love. Last but not least, but high-risk tax-saving strategy is venture capital trusts. High roller alert. Got a casual £200,000 lounging in your bank account? Well, say hello to venture capital trusts, VCTs. It's like a playground for the well-pocketed. Tax perk galore. The government's feeling generous. Invest in a VCT, and you get a sweet 30% tax relief on your investment. Drop in £70, and voila, the government slides in an extra £30 on your behalf. Dividends party. Dividends rolling in? Consider them tax-free goodies. No capital gains tax is gatecrashing this party either, as long as you keep the investment groove going for a cool 5 years. Risk factor. Handle with care. Now, let's talk real talk. VCTs are like the adrenaline junkies of investments. High risk, high reward, but not everyone's cup of tea. So, proceed with caution. As always, investments are risky instruments. Closing remarks. While these tax tips are tailored for the 2023-24 financial year, it's crucial to recognize that tax landscapes can be as changeable as British weather. Tax laws, allowances, and regulations may sway with economic winds, and individual circumstances bring their own unique climate. For the most precise navigation through this fiscal terrain, consulting a tax advisor is akin to having a seasoned guide in unfamiliar terrain.